Hey everyone, welcome to a Optimum FX educational video. As the title says, I'll be analysis video. I'm not going to be really talking about macroeconomics in this video, just pure TA. So as the title says, I'll be telling you about how to understand zones and understanding historical repetition. Because in my opinion, in my experience of the financial markets, history repeats itself over and over and over. And with that being said, price goes to a previous zone over and over and over, right? And there's a reason why, it's not just random. It's not just random, because at the end of the day, it's investors' behavior. And then at the end of the day, investors are pushing price to a certain level or a certain zone, right? There's no stop hunts or any kill zones or anything like that. At the end of the day, us as retail traders, we make up about 5 to 10% of the currency markets. So we can't actually manipulate the price to go to a certain area. So these investors, right? These investors, big time investors, they are pushing price to a certain level, okay? So I'm just going to explain to you about understanding the zones and understanding historical repetition, okay? So that being said, let's get right into it, okay? So where am I? We're on the pound against the dollar, okay? So we're on the pound against the dollar. We're on the 4-hour time frame. So this strategy here, this is what I use a part of my trading regime. So what I like to do, I like to mark out zones on the 4-hour, because when you do look at the 4-hour chart, you can see a lot more volume in the market of where price went in this 4-hour range, and then you got to realize, 6 of those candles is a day's movement, right? Okay, so I recommend, if you do want to mark out your zones, mark it on a higher time frame, probably like the 4-hour, the daily, the weekly, whatever your preference is. But my preference is just to go on the 4-hour, okay? So that being said, I'll quickly show you how I mark out these zones. And for instance, if you've been watching any of my weekly analysis on any pairs, I've always got my zones marked out. These zones are they could have been from a year ago, 2 years ago, 4 years ago, 5 years ago, whatever it may be. Because like I said at the start of this video, historical repetition happens over and over and over again, okay? And then with that being said, it's got to do with macroeconomics, because at the end of the day, that's what's moving price to a certain level, to a certain supply area, to a certain demand area, support, resistance, channel, whatever you want, Fibonacci level, whatever you believe in. So firstly, I'm just going to mark out some zones on the 4-hour, and yeah, let's just get this started. So what I like to do, I don't really like to draw lines. I don't really like to draw lines. I prefer to draw like a box, like a little, just like a little range, especially on the pound against the dollar. I'm looking at like a 20, probably like a 10 to 30 pip range, like 30 pip at the most. So for instance, so how I mark out these zones, all right? So how I mark out these zones, I usually mark them at the candle bodies, and usually arrange in the wick. Like I won't mark out a zone from 141 770 to 141 142 400. That's like a 70 pip range. So for instance, let me just bring it up. So for instance, I will just mark it from these candle bodies. I might do something like this, something just slightly above. And the reason I did it to this light here, right? This is just like a high time frame range. Okay, so we got this candle body open here, candle close here, candle body open here, and then with the highs, we've just got slightly above these candle body opens and closes, and just at this wick range here. Okay, so that's the main reason why I'm doing this level, 141.836. You know, this is like a 25 pip range, so that's fine. So I'm just going to mark out these zones, and then we can see that we did reject this level previously. So now we can see that as a higher, you know, as a higher time frame resistance, if you do want to think that. So I'm just going to quickly speed up this video because this video is just going to go for ages if you watch me in real time marking out these zones. So I'll just speed it up now. I know it's going to look a bit messy, but yeah, it's going to look a bit messy for some people. You know, that's just how they see it. But over time, if you do want to use a strategy, it can be very helpful because, you know, I feel like a lot of traders out there, like there's a lot of scalpers. Not many people intraday trade or swing trade or, you know, positional traders. So that means that most people, like not like at least 80% of traders that I'm familiar with are scalpers. You know, like you got a few swing traders, you know, holding positions for days on end or even weeks, possibly even months for those positional traders. But so with this being said, you know, when I'm doing my weekly analysis, I got these zones marked out on a higher time frame, right? And again, with historical repetition, because I know price on the higher time frame reached this level for a certain reason, whether it is that, and whether it was a key supply demand area or key support or resistance area, you know, like you can understand that there was liquidity in this area. You know, like for instance here, you can understand that when we're in this like tight consolidation here, there was not enough buy side liquidity to push to the upside. Especially like you can easily see on the high time frame as well. When you look at the 4 hour, you just got to look at where the wicks are, right? Because the wicks, that is just showing, wicks show exhaustion in the market, right? The candle bodies is actually the true strength of liquidity within that time frame, whatever the candle is, because each of these candles are 4 hours, right? So you got to understand that wicks are exhaustion. You know, wicks are exhaustion. That's what they are. Okay, so that's why I usually mark it off the candle body. Okay, yeah, I might mark off the candle body and, you know, mark the remaining zone at the top of the wick. But I can understand that if it does get, you know, for instance, you know, if it does get to the top of the wick or in this little area here, I know that's an exhaustion area. So with that being said, I can see a lot of you know, exhaustion when it comes to that area again. And, you know, for instance here, we come up here, you know, you could have taken a high risk sell at this area and it just comes down, right? Because there was previous exhaustion here and here. Because we know when we came down here, we just pushed to the downside, matching with this previous key level here, okay? So, you know, that's just a bit of an explanation from what wicks are telling you on a chart. It just tells you exhaustion. The counter body, that is showing you where the strength is, where the money is, where there's more money being moved. Okay. All right. So with that being said, so how I use these zones. Okay. So how I use these zones. So, you know, I do my weekly analysis, and then, you know, I'm a scalper, right? You know, I'm going on the 1 minute time frame, you know, maybe the 5 minute time frame. And if I'm looking out for where price might go throughout the day, I might look at the 30 minute, right? And I might scale in at the 1 hour, see where any candle body closures are. And then I'll scale down, see, you know, wait for an entry to line up, see, you know, little lower time frame order block or range being formed. And then, you know, I might scale down, look at a 1 minute, see a little break and retest, so forth. And then if I'm trading a pound against the US dollar, I'm looking for the exact same thing on Dixie, right? I'm looking for the exact same thing. But that's another video, all right? I was going to talk about, you know, marking out zones on a higher time frame. Okay, so with that being said, with these zones, you know, if you're scalping and then, you know, you scale out, because, you know, when you are scalping, you can get lost in the noise, right? So what I mean by loss in a noise, you'll be like zoomed in, completely zoomed in, completely zoomed in, and all you see is, what's this, 5:37 to, all you seen is like 60 minutes of price action right now, right? And what do you see here? Like, you see like nothing. So that's why, all right, so when you're scalping, you got these zones marked out. So you go, oh, well, hold on. This is a key level of interest, right? This is a historical price level. Why is price reaching this far? Or why is price rallied up this high over the last few days? Why? Like, why? We broke out as consolidation. We did do a nice sort of retest of this lower time frame order block. Now we're pushing up. Little consolidation area. Now we're pushing up even further. Like, why? And now we've reached this level and broken above. What's going to happen here, right? So that's why it's good to understand high time frame key levels, because like I said, you can get lost in the music. You can do, I think it's called like hyper scalping, where you're placing like 4 to 5 trades a day, even 10, 20, 30 trades a day, whatever it is, and you can just get lost in the noise, especially if you're on the 1 minute time frame. So with that being said, so what you can do, depending on how many trades you do a day or how many trades you do a week. So with these key levels, they're not going to be 100% accurate each time. If they were, I'd be rich as fuck right now. Okay, it'd be too easy, for price to reach a certain level, right? It'd be like way too easy, Like, for instance, if I knew this was the key level previously, I would have placed like a sell here, boom, we come down, but it didn't, right? It didn't here. So you just got to understand that, like, you can take the high risk entry once price reaches, this level here, you could have taken a sell, could have waited for the retest, taken the buy up, continuing that bullish momentum with optimism, in the UK economy and depreciation in the US dollar. So yeah, what you can do, with these zones being marked out, you could take like a high risk, buy or a sell once it reaches this level. I'll show you like a better example here. Show you. Hold on. Yeah, it'll probably be, yeah, like for instance here, you could have taken like a high risk sell here going, in your opinion, oh, no way it's going to keep rallying. Then you take a high risk sell at here, at the PPL psychological price level, 0.600, you're down about 6 pips, and then this thing depreciates what, 50 pips. If you caught that whole move, if you ever did catch a move like that, I applaud you. I applaud you. All right, and then we can see here. I know, like, this only happened the other days. This is like with CPI data from April. We did get a flip down and it hit our key level. Yeah. So it did hit our key level, and then we rallied up. Right. So yeah, like we did see that happen. Hit our key level on the freaking decimal. Pushed up. Like he took a high risk buy here at 810. Or even here at 959, only would have been a 15 pip drawdown. Could have placed your stop loss a bit below here, and let's just say you got in at 950. Yeah, 950. Let's say you went to this previous high here. That's like a 50 pip gain. Okay, 50 pip gain. Just for instance, of potential moves that you could have made. Okay, but what I just want to reiterate is that, with these high time frame key levels, all right, it's just historical repetition at the end of the day, because price is being pushed, like I said, to a previous supply, previous demand zone, right? Because that's investors' behavior, pushing price to a certain level, whether it be on a technical standpoint or, more importantly, on a macro standpoint. Like, price is being pushed to a certain level and price rejects at a previous level for some reason. Okay, like I said, history just repeats itself over and over and over again, and you just got to understand that. Okay, so yeah, that's just my opinion. And this is just one of the things I use, part of my trading strategy, part of my trading plan. you know. Yeah, and what you can do as well, because what I've noticed as well, because I trade London session, okay. So with I trading London session, you see sometimes you'll see like a strong liquidity grab. You'll see price like push up here, and then during liquidity, see price get pushed through a better supply zone, and then it rallies down. Okay, it's like I believe some people call it like the London kill zone or the London reversal, whatever it is. So yeah, like you can definitely see that happen a lot. Okay, so whole point of this video is just like marking out zones on the key levels, or just creating key levels, right? And this is just your opinion. So the foundation of this, marking out zones on a high time frame, usually the 4 hour, the daily, the weekly. And what you can do, what I like to do, it's going to take a bit of time if I do this myself. But actually, you know what? We'll hold on. I'll probably just like fast forward this bit. But yeah, just let me, just scale down a bit. So what was this? So right, okay. I'm just gonna do this quickly. So yeah, let's just freaking go here. So we see that little support being generated. So let's just see how these key levels line up, okay? I'll put it like really fast as well. So yep. So what time is this? So this is like Asian session at the moment. Asian session, failing to break these highs here is probably going to push up higher. It actually did push up higher. It's actually going too quick for me. Let me slow it down a bit. Alright, so it's about New York at the moment. It's consolidating, retesting. About an hour into New York. We retest up. We might continue this momentum. I want to see how we react at this key level. So yeah, we're reacting nicely. There's not much volume in New York session. Now it's Asian session. Creating a bit of consolidation. And we're trending downwards. 12. A bit too far. But yeah, like you can see, we did react strong off this key level here. Now we did a little strong reaction. Now we actually pulled back down. Was this? Yeah, that was New York session. That was a little liquidity grab at the open. And we pushed down, pushed back up. So yeah, this is like, it's a bit of a mess if you ask me. Now we're respecting this high time frame key level. If we break below, if we break and retest below, yeah, we could possibly continue down. I want to see how it reacts at this level here. Yeah, nice little retest here at 139.020. Bounce off this high key level here, 150. Like because these ranges here, they're like at least 50 pips. 50, 70, 90 pips, whatever it may be. What the fuck's this? This is from my experience in the markets, that is the most likely, what is it, high impacting news data, whatever it may be. Respecting this high time frame key level, respecting, it's a bit off, but you're not always going to be perfect. Respecting this high time frame key level, 130 at 200, we did rally to these highs. It's like 50 pips, and you can see a little lower time frame double bottom here. If we do break and retest below, we're going to continue down. We didn't get much of a retest. That's probably at an open. Yes, that was at London. Consolidating. We're just trending downwards. Respecting this high time frame key level. We're in this like little tight consolidation zone. Break and retest below here. We can see continued sells. No, we're just reacting very strongly at this level. So yeah, we did do a nice sort of break and retest of this high time frame range. Failed to go below. Nearly retested this level again. Strong rejections. Break and retest above. We can continue buying pressure. Fortunately, it was a fake out. But yeah, you can just, and I encourage you, once you do mark at your levels, just go and back test them and see how it lines up. If you like, you might see a certain level, you go, oh, all right, just let me adjust it to this level, make this range a bit smaller or larger. I would highly recommend having your ranges, at least like 40 pips, because ideally in a range, you're not always going to catch the whole range. You're not going to see this and for it to rally to this range here. Like you're not always going to see that. Okay, so ideally, you would have like a 50 pip range, but you're not targeting that 50 pips. You're most likely going to be targeting like 30 pips, right? Because you're not always going to get that whole freaking move. It'd be beautiful if it did happen each time, but the market doesn't work like that. So, we can see a little consolidation here. What time was this? I think that was at London Open. Was it? Yeah, that was like pre London there. Strong reactions at this level here. We did do a deep liquidity grab at the London Open, did push back up, failed to break above, break and retest these highs. Geez, these key levels do not lie. And then what you got to understand is, if you're trading on a lower time frame, because with scalpers, that you're only trying to target 10 to 30 pips. Like ideally, like 30 pips for a scalper is like unbelievable. And then, possibly if you, always have runners, some scalps can turn into intraday trades, instead of catching your, 10 to 30 pips, this thing could extend out to 80 pips. You could have bought here, gone, all right, we've, retested the zone, set my stops at break even at this key level here, didn't break. Now we're just in this little zone here. And if we got the fundamental and technical confirms it lined up, we could have waited an extra day or so for it to come back up to the next key level. Yeah. Oh yeah, this is just when the pound was just like freaking pumping. Sorry. But yeah, this is just one of the systems I use when it comes to trading, because I am a scalper, like I said, and once I see price, reaching these previous levels, I can go, all right, hold on, just let me see how it reacts at this level here. I could be taking a high risk. I could be taking a position at like a double bottom, or possibly waiting for like a break and retest. A double bottom's more of an impulsive trade, in my opinion, because you'll just wait. So you're just taking, for instance, let's say here, this is a double top, for instance, and this double top matches with this double bottom. It's a little SR flip, and then we did reject hard, and you take the position at 0.900, and you get at ooh, that's a nice range. That's like a 60 pip range. But then your safer trades are, when you kind of do like a break and retest here, like I know for a fact that's a session open. Or was that just late in New York? Yeah, that was just actually late in New York. So we did retest a little lower time frame OB high. So yeah, you can just look at these key levels. You break and retest, come down. We come here. If we break and retest below, we're going to come down, or we're going to respect our high time frame key level. Create a little order block consolidation zone. Break and retest here. Did take this, could have taken the shorts here. Little order block. If we retest up here, if we stay above this level, we can continue buying pressure. It's failing. Oh, doesn't want to come down. This is all happened in the past, but it's interesting. Just watch price action. A fat liquidity grab, the fattest, but didn't break our previous lower time frame low. Failed to break, little break and retest at the zone here. Now we're just trending up. Break and retest above here, we could see continue bias. Easy set, creating a little consolidation zone prior to London. Yeah, yeah. That break and retest was a little fake out. New York. So this was like a rangy day. Oh, and this is where we are today. So, you know, we just witnessed a month of price action on the 15-minute time frame. Alright, I'm just going to cut this video. I'm just going to cut this video here. So hopefully you did learn a thing or two about historical repetition, higher time frame key levels, and just understanding price. So if you enjoyed the video, be sure to like and subscribe. And yeah, I'll talk to you next time.